With me today, I have star investor Bill Ackman, CEO of FTSE 100 company Pershing Square Holdings. Hi, Bill. Thanks for joining me today.
Same. Good to see you.
Now, Pershing Square Holdings has just taken a 10% stake in Universal Music Group, UMG, the music rights owner, as part of its spin out from Vivendi. You're betting big on a single company. What makes you so confident you'll make a profit on this investment?
Sure. Just for clarification, Pershing Square Holdings owns about perhaps 7.5% of UMG, the other funds that we manage on the balance. We've raised a co-investment vehicle. But yes, it's a large investment. And we size investments based on our perception of both risk, what's the probability that we lose money, and what's the opportunity for gain. And in this case, we think at the price paid, the probability of a loss for us was about as low as we could calculate. And then on the upside case, we thought there was a huge opportunity versus even everything else we owned. So it had the most upside and the least downside, at the price paid. And that made for a really attractive investment. And what drove the nature of this investment, what makes it so appealing, is really the changes that have taken place in the music industry really over the last couple of decades. But what you had is a business that was a pretty good business in the 90s that became a terrible business as music piracy, theft basically killed the business. Apple began a recovery with the iPod and then the iPhone and the beginning of music, digitization of music that people would pay for, but that was not a great recurring business. Really Spotify that saved the industry, working with Universal initially to build out a consumer offering that was appealing. And it was so appealing that rather than steal music, people signed up and paid the relatively modest, a few dollars a month, $5, $6 a month for a family plan today. And, globally, that number is in the low single digits in some of the more emerging markets to sign up for a streaming account. And it's really music streaming over the last decade. And the lines crossed in really 2015 when the declines from the physical sales and downloads were replaced by revenue from streaming. And when those lines crossed, all of a sudden it became a growth business as the streaming business became a substantial percentage of the revenues, and it grew much more quickly. And so what you had was a kind of hits-driven business where people would go buy a physical, think CD, think of the logistics involved in delivering, manufacturing, the capital intensity of that, the physical delivery, dealing with the inventories, dealing with the returns, trying to get it right, versus a business of, just getting participation in the monthly subscription revenues of the distributors like Spotify. And going from Spotify, when you had only really one DSP to now Apple Music, YouTube Music, Amazon Music, there are a couple hundred other streaming services. So if you look at this business, as we often do, using kind of a competitive strategy analysis, I'll steal from Michael Porter. We think the company's really uniquely positioned. And in music, Universal owns the rights, in effect, on a third of global music. And that's a very, very strong and dominant position for the company. And they've earned that by virtue of really being the best place to go if you're an artist and you want to become a superstar. You want to partner with Universal. And they've got the best management team. They've got the most market share, and they're taking share. So it's best business in an amazing industry. And the way to think about the business today is it's really just owning a royalty on people listening to music. And I think of all the assets in the world, music is one where, as I've said before, other than food and, let's say oxygen, it's a certainty people are going to consume music over the next 1,000 years. They consumed a lot of it over the previous 1,000 years. They're going to consume even more because it's cheaper, it's easier to get access to it. It's become more important. I can go on, but look at what's going on in social media. I mean, TikTok built a business worth, reportedly $100+ billion, selling these little music videos. And up till very recently, earlier this year, they're paying nothing for those music rights. And now Universal is beginning to receive revenues from the TikToks of the world and all the other social media applications where they realize if you add music, people spend more time. And time is what advertisers pay for. It's a lot of controversy with Facebook, where anger drives people's attention on social media. But the other thing that drives people's attention, if you add music to an application, an exercise app, to Facebook. And so it's a very high quality, great business, and we bought it at a very attractive price.
Yeah, well, my next question was going to be, what is it about Universal that fits into your portfolio? Now, you've given us a lot on Universal there, but what jumps out is its dominant market position. Are there characteristics that you adopt on stock acquisition across your portfolio that Universal ticks all those boxes? It
literally ticks all the boxes. When we describe what we're trying to do, we try to find simple, predictable, free cash flow generative business. This is precisely that. We like businesses that earn very high returns on capital. This is precisely that. We like businesses with strong, dominant market positions with strong balance sheets. The company has about €1 billion of net leverage, and it's really zero leverage when you net out the market value of their Spotify stake. So it's a conservatively financed, super high quality, high return on capital, predictable, fast growing, durable growth company. And we're able to buy it at an attractive price. And so that's the reason we kind of put big chunk of the chips on the table on this one. And we think it's something we can own for a decade or more. So that they don't come around that often. And when you find them, you got to bet big.
Other than Universal, has the Pershing Square portfolio changed much in the past 6 months? What stocks have you been buying and selling, and why?
Sure, we sold Agilent, which is an amazing business. We more than doubled our money in a couple of year period of time, and we did even better, of course, because we bought a lot more of that position during the pandemic last year. It's a really well-run company. Fits a lot of the attributes we've talked about. The only negative is the market kind of revalued it to a price where we still think it's going to be an attractive, kind of low double-digit return for a stock market investor, but we needed capital to make our commitment to Universal. So we sort of regretfully sold Agilent. But it's an amazing company, and we wish the management team well. But it was only because of scarce resources. At the price paid, Universal was a better business. At half of Agilent's price, obviously wouldn't sell it there. But we're always open to selling even a long-standing holding if it reaches a price where it's hard for us to earn the kind of returns we'd like to earn for our shareholders, and where we found a better use of the money. And that's what happened here. But other than Agilent, we really haven't done anything new in the kind of positions.
Well, because of the Universal deal, do you now sort of think, well done, everyone. We'll sit back for a bit. We've made it's a great trade, great investment. We won't be doing anything for a while now? Or are you always on the lookout? And if another Universal or another big opportunity came along, would you then think, well, let's look at how we can finance this if we have to sell something? You're always on the lookout, are you?
For sure. I stepped out of an investment team meeting where we're looking seriously at a new idea to take this, to do this video with you. So absolutely, we don't rest on our laurels, so to speak. The other thing I'll point out, actually, which is significant, is we just did a bond financing. And we raised 500 million euros of debt at a 1.4% interest rate fixed for 6 years, unsecured, no mark-to-market covenants, and 700 million of US dollar bonds at a, just call it 3.25% yield, a 10-year instrument. That's, call it $1.3 billion of incremental cash we raised. And then we tendered for our public debt, and we're only able to buy back about a third of it. So we've actually have a decent amount of free capital to put to work, which we would love to put to work on a new idea. And one of the things I think is not appreciated about Pershing Square Holdings, if I could diverge for a second, is, one of the questions is, why do we issue this long-term debt? Why don't we use margin debt? Well, so number one, we'll never use margin debt because it's, if the market crashes, you can be wiped out and be forced to sell at precisely the wrong time. And the fact that we are a closed-end fund, we own the highest quality businesses in the world, allows us to borrow money at extremely attractive rates, certainly in our view. Blended cost of that capital was something in the twos. And we can deploy that capital and earn, we're looking to earn well north of a 20% return. About 20% of our capital today is represented by that debt, right? 20% of our total assets. Balance, 80% is represented by the shares that our shareholders own. When you look at the fact that we charge a management fee and an incentive fee, people obviously view that as a negative because that's a drag on returns versus owning the underlying portfolio directly. But the fact that we've replaced 20% of our equity with very, very low cost debt basically makes up for the fees that we charge. And so interestingly, if you look at the gross returns of our private funds and you compare them with the net returns of PSH, they're basically about the same. And so you can effectively invest in Pershing Square Holdings and earn the underlying return on the assets without paying the fees economically because of our ability to issue very, very low cost debt. And so that transaction, which we just did, at the tightest spreads at which we've ever issued debt, and we issued our original bonds, call it 7 years ago. They were issued, or 6 years ago, they were issued at a something in the 350 basis point spread. We just issued debt at 160, 170 basis point spread. And so that is a very significant event, I think was ignored by the market. We can now take that capital and go invest it in something and earn a much, much higher return. And that, of course, will help create intrinsic value or growth in our NAV. And so, fast forward over time, we make a great new investment. It increases NAV by a nice amount. That frees up, that reduces our leverage, allows us to issue, elongated debt at an attractive price, and it continues. And we'll always keep that leverage quite low, so we don't think it meaningfully affects the risk of Pershing Square Holdings. And so it's a really attractive development that I don't think anyone's focused on or thought about.
Great. Bill Ackman, CEO of Pershing Square Holdings, thank you very much for joining me today.
Sure. Thank you, Lee. Appreciate it.